Welcome back to CMA USA Exam Coach. Today we are going to dive into a very important topic from Part 2 of your CMA exam Cost Volume Profit Analysis, also called CVP Analysis. Cost Volume Profit Analysis is a tool that helps businesses understand how their costs and sales levels affect their profits. It shows the relationship between selling price, cost, sales volume, and profit. This analysis helps managers answer important questions like, how many units do we need to sell to break even? What happens to profit if we increase the selling price or reduce costs? How much profit can we make if we sell a certain number of units? In this episode, we'll break it down step by step and explain all the key terms in a simple way. So, stay with me till the end, and by the time we finish, you'll have a strong understanding of how CVP analysis works. Let's get started.
We're diving into Cost Volume Profit Analysis, or CVP analysis for short. This concept is also commonly known as break-even analysis, and in this lesson, I'll explain what it means, how it works, and why it's such a useful tool for managers when making decisions. Let's go step by step in simple language, so even if this is your first time hearing about CVP, you'll have no problem understanding it. So first, we said that CVP analysis is also called break-even analysis. Why? Because one of the main goals of this analysis is to find out the break-even point. This is the point where your total revenue exactly equals your total costs. So, there's no profit and no loss. You're just covering all your expenses. From this point onward, any additional sale will start creating profit. That's why it's called break-even. It's the level of sales where your business breaks even. Next point. CVP is used for short-term decisions. This means we usually use this tool to make decisions that affect the business in the near future, maybe over the next few months or 1 year. For example, if a company is thinking about offering a discount, launching a marketing campaign, or producing more units, CVP helps us understand what impact that decision will have on profit. It's a quick and effective way to test different business options. Now, let's look at another important use. CVP analysis helps find how much quantity we need to sell to reach a profit target. Let's say the business wants to earn $50,000 in profit this quarter. Using CVP, we can calculate exactly how many units they need to sell to reach that goal. So it gives a very clear target for the sales team and helps with planning production, pricing, and budgets. Then we have CVP is used to calculate the break-even point. Again, this is the point where there's no profit, but also no loss. Knowing the break-even point is very important when you launch a new product or start a new project. It helps you answer the question, how much do I need to sell just to cover my costs? If you don't know your break-even point, you're basically flying blind. Next, CVP can also help calculate the sales revenue needed to earn a specific profit. Sometimes, instead of asking how many units to sell, you might want to know how much total revenue you need to generate to reach a profit target. CVP lets you calculate that too. So, if your goal is to earn $100,000, you can figure out how much total sales you need, based on your cost structure. Now here's the core of CVP. It shows the relationship between cost, volume, and profit. In other words, how your profit changes when your cost or volume changes. It helps answer questions like, what happens to our profit if we increase the selling price? Or, how will profit be affected if raw material costs go up? This relationship is very important in day-to-day business planning. And finally, CVP uses something called the contribution margin income statement. Now this is different from the traditional income statement. The contribution margin format separates costs into variable costs and fixed costs. This is important because in CVP, we focus on how much each unit sold contributes to covering fixed costs and generating profit. That's why the contribution margin is such a powerful concept, and we'll explore it in more detail in the next slide. So in summary, CVP analysis is a practical, short-term planning tool that helps managers understand how sales, costs, and profit are connected, and helps them make smarter decisions. Before we move further into cost volume profit analysis, It's very important to understand the assumptions behind this model. Every financial model or tool works based on certain assumptions, and CVP is no exception. These assumptions help simplify real-life business situations so that we can analyze them more easily. So let's begin with the first assumption, and we'll explain it in detail before we move on to the next one. Assumption number 1. Production is equal to sales. What does this mean? This assumption tells us that the number of units produced is exactly the same as the number of units sold. In other words, there is no change in inventory levels. The company does not hold any finished goods in stock at the end of the period, and it also doesn't begin with any opening inventory. Let's take a quick example. Suppose a company produces 1,000 units of a product during the month. Under this assumption, it also sells exactly 1,000 units during the same month. That means there are no unsold products left in inventory. Now, why is this assumption important in CVP analysis? Because if production and sales are not equal, then the fixed costs per unit and the contribution margin may not give us an accurate picture of profit. When units are produced but not sold, the cost of those units is added to inventory. That means some fixed overheads are sitting in inventory and are not being expensed in the income statement. This can lead to overstatement or understatement of profit. So, by assuming production equals sales, we can avoid the complications of inventory accounting and focus purely on the relationship between cost, volume, and profit. In simple terms, it helps keep the analysis clean and straightforward. Assumption number 2. All costs should be classified as either variable costs or fixed costs. This is another key assumption in cost volume profit analysis. It means that, for the purpose of CVP, we must clearly separate every cost in the business into two categories: variable costs and fixed costs. Let's understand this better. First, what are variable costs? These are costs that change directly with the level of production or sales. The more units you produce or sell, the higher the total variable cost. Examples include direct material, direct labor, and variable selling expenses. If you produce 1 unit, your cost may be $5. If you produce 2 units, it becomes $10. Now, what are fixed costs? These are costs that remain the same, no matter how much you produce or sell, at least within a certain range. Examples include rent, salaries, depreciation, and fixed administrative expenses. Whether you make 10 units or 1,000 units, your fixed rent remains the same. So what does this assumption mean in practice? It means that for CVP to work correctly, we must ignore semi-variable or mixed costs, or we must split them into their fixed and variable components. For example, if you have a utility bill that has a fixed monthly charge plus a usage-based charge, we must divide that into its fixed part and its variable part before using it in CVP analysis. This clear separation is essential because the contribution margin, which is a core part of CVP, is calculated based on variable costs being deducted from sales. Then we use that margin to cover fixed costs and calculate profit. If costs are not properly classified, the CVP results will not be accurate, and decisions made from that data could go wrong. So to summarize, this assumption requires us to clearly define which costs are variable and which are fixed, and there should be no confusion or overlap between the two. Assumption number 3. Certainty. The parameters should be known or can be reasonably estimated. This assumption is all about predictability and accuracy. When we perform CVP analysis, we need to input certain key data, like the selling price per unit, the variable cost per unit, the total fixed costs, and the expected sales quantity. This assumption tells us that these parameters, selling price, cost, and quantity, should either be known exactly, or at least we should be able to estimate them with reasonable accuracy. Why is this important? Because CVP is a mathematical model, and just like any calculation, if we put in incorrect or unrealistic numbers, the results will also be incorrect. This is what we call garbage in, garbage out. Let's take an example. If we are unsure about our selling price and it keeps fluctuating wildly, We can't rely on CVP to give a meaningful break-even point or profit estimate, or if our variable cost is not fixed per unit, or if we're not sure how many units we can sell, our profit forecast will become just a guess. So this assumption ensures that we're working with reliable inputs. It doesn't mean everything must be perfectly accurate, but it does mean we should be confident that the values we're using for price, cost, and sales volume are reasonably close to the actuals. For example, if we're doing CVP analysis for the next quarter, we might use our average selling price and cost data from the past few months and make a sales estimate based on past trends. So to conclude this assumption, for CVP to be useful and meaningful, we must either know the key values or we must be able to reasonably estimate them based on past data, market research, or industry expectations. Assumption number 4. Linearity. If one increases, another should also increase. This assumption is based on the idea of a linear relationship. That means a straight line connection between sales volume, revenue, and costs. Let me explain this in simple words. Linearity means that when sales volume increases, both the sales revenue and the costs should increase in the same proportion. Let's break this down further. Suppose you are selling 1,000 units at $10 each. Your total revenue is $10,000. Now, if you double your sales and sell 2,000 units, your revenue should also double, becoming $20,000. The same logic applies to variable costs. If it costs you $6 to make one unit, your total variable cost for 1,000 units is $6,000. If you now produce 2,000 units, the variable cost should double to $12,000. This linear pattern helps us to predict outcomes more easily. We assume that each extra unit brings the same amount of revenue and cost. There are no discounts, no extra fixed expenses, and no changes in cost per unit. That's what we mean by linearity. It also means fixed costs remain fixed, and variable costs per unit remain constant, even as production or sales increase. In the real world, of course, some of these things may not stay exactly the same. But in CVP analysis, we make this assumption to simplify the model and allow us to perform calculations. So, to summarize, linearity assumes a straight-line relationship. When sales go up, revenue and costs go up in the same ratio. The selling price per unit and variable cost per unit stay constant, no matter how many units we sell. This makes CVP analysis easier to work with and helps us draw clearer insights. Assumption number 5. Single product or defined product mix. In cost-volume profit analysis, this assumption is very important when a company is producing more than one product. Let's first understand the two scenarios. If the company is producing only one product, then the analysis becomes simple. We calculate contribution margin, sales, costs, and profit just for that one product. But if the company produces multiple products, then CVP analysis assumes that the sales mix, or product mix, is defined and constant. So, what is a defined product mix? It means that the proportion or percentage of each product in the total production and sales remains the same. Let's take a simple example. Suppose a company makes 3 products: Product A, Product B, and Product C. If the company always sells these 3 products in a ratio like 50% A, 30% B, and 20% C, then that is called a defined product mix. This assumption says that this ratio should not change during the analysis period. Why is this important? Because contribution margin is different for different products. If the product mix changes, then the overall average contribution margin also changes, and that will affect the break-even point and profit analysis. So, to make CVP analysis meaningful, we assume either the company sells only one product or, if it sells multiple products, the product mix is fixed and clearly defined. This assumption helps in keeping the calculations consistent and reliable. If the actual mix of products changes frequently, then CVP analysis becomes less accurate. So, to summarize, in CVP analysis, we assume a single product or a constant product mix across the entire volume of production and sales. This simplifies the analysis and makes the break-even and target profit calculations more stable. Assumption number 6. Time value of money is ignored. In cost volume profit analysis, another important assumption is that the time value of money is ignored. Now let's understand what this means in a simple way. The time value of money is a concept in finance that says, a dollar today is worth more than a dollar in the future. This is because money has earning potential. If you have money now, you can invest it or use it to earn returns. However, in CVP analysis, we completely ignore this concept. We assume that all revenues and costs occur within a short time period, such as the same year or the same accounting cycle. So, the difference in timing between cash inflows and outflows is not considered important. In other words, we do not apply discounting or present value calculations in CVP. We treat all dollars, whether earned or spent, as if they have the same value, regardless of when they happen during the period. Why do we make this assumption? Because CVP is mostly used for short-term decision-making, like determining how many units to sell this quarter to break even, or what level of sales is required to meet a profit target in the current year. In such short-term decisions, the effect of time value is usually very small and can be ignored without much impact. So, to keep the analysis simple and focused, we assume the time value of money is not considered in CVP calculations. This helps managers make quick and straightforward decisions without complex financial adjustments. Let's now look at another important set of assumptions in CVP analysis related to cost behavior. There are 4 major assumptions under this category, and it's important to understand the difference between them clearly. First, variable cost. Per unit is fixed. This means that for every single unit of product sold or produced, the variable cost remains exactly the same. For example, if it costs $5 in material and labor to make 1 unit, it will cost $5 for the second unit, $5 for the third unit, and so on. There is no increase or decrease in cost per unit, regardless of how many units are produced. So, in CVP analysis, we assume constant variable cost per unit. Second, total fixed cost is fixed. This assumption says that the total amount of fixed costs remains unchanged over the relevant range of production. For example, if the monthly rent for a factory is $10,000, it will remain $10,000 whether the company produces 1,000 units or 10,000 units. So, in CVP analysis, total fixed cost is treated as constant for the given level of activity. Third, variable cost is not fixed. Now, this may sound confusing at first. We just said variable cost per unit is fixed. So, what does this mean? Here, we are talking about total variable cost, not per unit. Total variable cost is not fixed. It changes in proportion to the number of units produced or sold. For example, if variable cost per unit is $5, then, for 1,000 units, total variable cost equals to $5,000. For 2,000 units, total variable cost equals to $10,000. So, even though per unit cost stays the same, the total variable cost increases with volume. That's why we say variable cost is not fixed overall. Fourth, fixed cost. Per unit is not fixed. This assumption says that when we calculate fixed cost per unit, it changes with the number of units produced. Let's understand this with a simple example. If total fixed cost is $10,000 for 1,000 units, fixed cost per unit equals to $10. For 2,000 units, fixed cost per unit equals to $5. So, when production increases, the fixed cost per unit decreases. That's why we say fixed cost per unit is not fixed. Only the total fixed cost stays the same. In summary, CVP analysis assumes variable cost per unit stays constant, total fixed cost stays constant, but total variable cost changes, and fixed cost per unit changes. These cost behavior assumptions are very important because they help simplify the CVP model and make decision-making easier for management. Now let's move to an important part of CVP analysis, understanding target quantity and target revenue. Let's go step by step using a very simple and relatable example. Imagine I have a product, a cool drink that I sell in cans. My selling price is $5 per can. The variable cost is $3 per can. So that gives me a contribution margin of $2 per can. Now what does this mean? Every time I sell one can, out of the $5 selling price, $3 goes to cover the variable cost like ingredients, packaging, etc. And the remaining $2 becomes my contribution margin. This $2 doesn't go to profit yet. It first goes to recover the fixed costs. So let's say my total fixed cost is $5,000 per month. Now here's the key question. How many cans do I need to sell to recover this $5,000 in fixed costs? We can easily calculate that by dividing the fixed cost by the contribution margin. $5,000 divided by 2 equals to 2,500 cans. So, I need to sell 2,500 cans to cover my fixed cost completely. Let's pause and think about what happens at that point. If I sell exactly 2,500 cans, then my variable cost is fully covered. That happens automatically through the contribution margin. My fixed cost of $5,000 is fully recovered through the $2 contribution margin from each unit, and my operating profit is zero. In this case, there is no loss and no profit, just a perfect balance. This point is called the break-even point, where all costs are covered, and we're just ready to start earning profit. Now let's take it one step further. What happens if I sell just one more can, that is 2,501 cans? Now I'm still earning $2 of contribution margin per can, but since I've already covered all my fixed costs at 2,500 units, this extra $2 from the 2,500 first can become pure profit. From that point onward, every can I sell adds $2 directly to my operating profit. So this is how we calculate and understand. Target quantity. How many units we need to sell to achieve break-even or a profit goal, and how contribution margin helps us recover fixed costs and eventually start making profits. To summarize, contribution margin is used to cover fixed costs first. Break-even point is reached when total contribution margin equals total fixed cost. After break-even, each unit sold adds directly to profit. This is the basic logic behind target quantity and target revenue calculations in CVP analysis. Let's now move forward and see how to apply this in actual formulas and more practical examples. Now let's take a deep dive into target quantity and target revenue, using 3 important CVP equations. These formulas help us understand how many units we need to sell or how much revenue we need to earn in order to cover our fixed costs and reach a desired level of profit. Let's start with the first one. First target quantity formula. Target quantity equals to fixed cost plus operating income divided by contribution margin per unit. This equation tells us how many units we need to sell in order to first recover all fixed costs and then earn a target operating income. Let's understand the components. Fixed cost. These are expenses that do not change with sales volume, like rent, salaries, insurance, etc. Operating income. This is the profit we want to earn after covering all costs. Contribution margin per unit. This is the amount we earn from each unit after subtracting the variable cost. So, what we are doing here is adding fixed cost and operating income, which gives us the total amount we need to recover. Then we divide it by the contribution we make from each unit. This gives us the total number of units we must sell. This is called the target quantity. Second, target revenue using contribution margin ratio. Target revenue equals to fixed cost plus operating income divided by contribution margin ratio. Now this formula is useful when we want to calculate how much sales revenue we need to achieve our target. The logic is the same as the previous one. We first add fixed cost and operating income, which gives us the total amount we need to cover. But this time, we divide it by the contribution margin ratio, not the amount per unit. The contribution margin ratio is the percentage of each sales dollar that contributes toward covering fixed costs and generating profit. So this formula helps us find out the exact sales revenue needed, in dollars, to reach our profit goal. This is useful when a business is more focused on revenue figures rather than just unit sales. Third, target revenue from target quantity. Target revenue equals to target quantity times selling price. Once we know the target quantity, which tells us how many units we need to sell, we can multiply that number by the selling price per unit to find the total sales revenue. This is a simple formula, and it connects the quantity and the revenue together. It also helps us verify our earlier calculations, whether the units and revenue are aligned with our goals. So, to summarize, first, use the target quantity formula to know how many units you need to sell. Second, use the target revenue formula using contribution margin ratio if you want to directly calculate sales in dollars. And finally, use the target quantity times selling price formula to convert quantity into revenue. All three formulas are very important tools in cost volume profit analysis, and they help managers make clear decisions about pricing, production, and profitability. Let's understand how to calculate target quantity and target revenue using a simple example. Let's take the following case. Selling price per unit is $10. Variable cost per unit is $4. Desired profit, also called target operating income, is $300,000. And fixed cost is $600,000. Now we want to find two things. How many units we need to sell to achieve our profit target. This is called target quantity. And what should be our total sales? This is called target revenue. Let's start step by step. First, we calculate the contribution margin per unit. Contribution margin means how much money is left after covering variable costs from each unit sold. So we take the selling price and subtract the variable cost. Selling price is $10. Variable cost is $4. So contribution margin per unit is 10 minus 4 equals $6. This means for every product we sell, $6 will go towards covering fixed cost and profit. Next, let's calculate the target quantity. The formula is target quantity equals fixed cost plus desired profit divided by contribution margin per unit. Let's plug in the values. Fixed cost is $600,000. Desired profit is $300,000. Contribution margin per unit is $6. So, target quantity equals to 600,000 plus 300,000 divided by 6. That is 900,000 divided by 6, which equals 150,000 units. So we need to sell 150,000 units to cover our fixed cost and also achieve the desired profit of $300,000. Now let's calculate the target revenue, which means how much total sales value we need to achieve this target. To do that, we first need the contribution margin ratio. This ratio shows what percentage of every sales dollar contributes to covering fixed costs and profit. Contribution margin per unit is 6. Selling price is 10. So, CM ratio equals to 6, divided by 10 equals to 0.60 or 60%. This means 60% of the revenue goes towards fixed cost and profit. Now use the formula. Target revenue equals fixed cost plus desired profit divided by contribution margin ratio. So we get target revenue equals to 600,000 plus 300,000 divided by 0.60. That is 900,000 divided by 0.60, which equals $1,500,000. So, to achieve the target profit of $300,000, we need to generate $1.5 million in sales. Let's now look at another example to understand how to calculate target revenue and target quantity when the company is aiming for a specific profit percentage on total sales. Here's the situation. The selling price per unit is $10. The variable cost per unit is $4. The fixed cost is $1,000. And the company expects a profit of 20% on total sales. So now, instead of giving us a fixed dollar profit, like in the last example, They are asking us to calculate how much revenue and quantity is needed to earn 20% profit on total sales. Let's break this down step by step. Step 1. Understand the concept of profit based on sales. When a company says it wants a 20% profit on sales, it means that out of the total revenue, 20% should be profit. But to find how many units we need to sell to reach that profit, we must first adjust our formula. We already know the basic formula for target quantity is target quantity equals 2 fixed cost plus desired profit, divided by contribution margin per unit. But here, the desired profit is 20% of the total revenue, which we don't yet know. So, instead of using the regular formula, we use a modified version that works when profit is based on percentage of sales. Step 2. Calculate the dollar amount of profit per unit. Selling price per unit is $10. Profit expected equals to 20% of selling price. So profit per unit equals to $10 multiplied by 20% equals to $2. That means the company wants to earn $2 profit from each unit sold. Step 3. Find the contribution margin per unit. Selling price equals to $10. Variable cost equals to $4. So contribution margin is 10 minus 4 equals to $6. Now we want to split this contribution margin of $6 between covering the fixed cost and earning profit. Out of this $6 margin, $2 will go towards profit. That leaves $4 to cover fixed costs. Step 4. Use the adjusted target quantity formula. Target quantity equals to fixed cost divided by contribution margin minus profit per unit. Equals to $1,000 divided by 6 minus 2. Equals to $1,000 divided by 4. Equals to 250 units. So we must sell 250 units to cover the fixed cost and earn 20% profit on sales. Step 5. Calculate the target revenue. Now that we know we need to sell 250 units, and each unit is sold for $10, the total revenue needed is target revenue equals to 250 times 10 equals to $2,500. Final answer, target quantity equals to 250 units. Target revenue equals to $2,500. So, by selling 250 units, the company will cover its fixed costs and earn exactly 20% profit on the total revenue. This is how we handle target profit questions when the profit is given as a percentage of sales, not a fixed dollar amount. Now let's look at the adjusted contribution margin formula, which is used when the desired profit is given as a percentage of sales revenue, not as a fixed dollar amount. In this case, both the target quantity and target revenue need to be calculated differently because the desired profit is linked to total sales, not fixed separately. Let's begin with the formula to calculate target quantity. The formula is target quantity equals 2 fixed cost divided by contribution margin per unit minus profit percentage multiplied by selling price. So what exactly is happening here? We take our fixed cost, which is the total amount that must be covered no matter what. But now, instead of subtracting just the contribution margin per unit like in regular CVP questions, we adjust that margin by subtracting the portion of selling price that will go toward the desired profit. For example, if the profit is 20% of sales and our selling price is $10, then 20% of $10 is $2. So we subtract that $2 from the regular contribution margin per unit to get our adjusted contribution margin. This adjusted contribution margin tells us how much is left from each unit to cover the fixed cost, after setting aside the profit portion. Once we have that number, dividing the fixed cost by this adjusted margin gives us the number of units we need to sell. That is our target quantity. Now let's look at how to calculate target revenue in this case. Target revenue equals 2 fixed cost divided by contribution margin ratio minus profit percentage. Again, here we are using percentages instead of unit-level amounts. The contribution margin ratio tells us what percentage of each dollar of sales is available to cover fixed costs and generate profit. If part of that is now allocated to profit, we subtract the profit percentage from the contribution margin ratio to get the adjusted contribution margin ratio. We then divide the fixed cost by this adjusted ratio to get the target revenue, which is the total sales revenue required to both cover fixed cost and achieve the desired percentage profit. This method is especially useful when companies have a profit goal defined as a percentage of total sales, which is quite common in real business settings. Now let's take a moment to understand a very important concept in cost-volume profit analysis, and that is the break-even analysis. Break-even analysis helps us identify the level of sales at which a business covers all its costs, but does not make any profit. In simple words, it's the point where total revenue equals total cost. And at this point, there is no profit and no loss. Let's break this down further. In any business, we have fixed costs, like rent, salaries, and insurance, which must be paid even if you sell nothing. Then we have variable costs, which depend on the number of units you sell. For example, direct material and direct labor. Now, every time you sell a product, part of the selling price goes to cover the variable cost, and what remains is known as the contribution margin. This contribution margin per unit helps to cover the fixed costs. So, unit by unit, the contribution margin is slowly paying off the fixed cost. Now here's the key point. When the total contribution margin from all units sold is exactly equal to the fixed cost, then you are said to be at the break-even point. At this point, you've recovered all your fixed costs, but you haven't made any profit yet. If you sell even one more unit beyond the break-even quantity, then that extra contribution margin will directly become your operating profit, because your fixed cost is already covered. For example, if your fixed cost is $5,000 and each unit gives a contribution margin of $2, you'll need to sell 2,500 units to break even. The sale of the 2,501st unit will start generating profit, $2 for each additional unit sold. So, break-even analysis helps businesses understand how much they need to sell before they can start making a profit. It is a vital tool for planning, decision-making, and setting sales targets. Now let's look at the key formulas used in break-even analysis. These equations are very important to calculate how much a company needs to sell in order to reach the break-even point. That is, to cover all its fixed and variable costs without making any profit or loss. First, we have the formula for break-even quantity. Break-even quantity equals fixed cost divided by contribution margin per unit. That means we take the total fixed cost and divide it by how much contribution we earn from each unit. This tells us how many units we must sell to exactly cover our fixed costs. Next, we have the formula for break-even revenue. Break-even revenue equals fixed cost divided by contribution margin ratio. Here, instead of calculating units, we are directly calculating the amount of sales revenue required to break even. We divide the fixed cost by the contribution margin ratio, which tells us the percentage of each sales dollar that contributes toward covering fixed costs. And finally, if we already calculated the break-even quantity and we know the selling price per unit, we can also find the break-even revenue using this formula. Break-even revenue equals break-even quantity multiplied by selling price. This simply converts the break-even quantity into total dollar revenue. So, once we know how many units we need to sell to break even, multiplying that by the selling price will give us the break-even sales in dollars. Together, these three formulas are powerful tools that help management in pricing decisions, cost control, and sales planning. Now let's take a look at a detailed break-even point question. This question will help you understand how to apply the formula in a more realistic business scenario. Question: the company manufactures a single product. The estimated data and other relevant information are as follows. Selling price per unit is $40. Total variable production cost is $22. Sales commission is 5% on sales. Manufacturing overhead is $5,598,720. General and administrative expenses are $3,732,480. The tax rate is 40%. Now, based on this information, we need to calculate the number of units the company must sell in the coming year to reach the break-even point. That means no profit and no loss. Let's start solving step by step. Step 1. Calculate total fixed costs. We are given two types of fixed expenses. Manufacturing overhead, $5,598,720. General and administrative expenses, $3,732,480. So total fixed cost equals $5,598,720 plus $3,732,480 equals to $9,331,200. This is the amount that must be covered by the contribution margin in order to break even. Step 2. Calculate total variable cost per unit. The variable production cost is given as $22 per unit. In addition, we also have a sales commission of 5% on the selling price. Since the selling price is $40, 5% of 40 is 0.05 times 40 equals to $2. So, the total variable cost per unit is $22 plus $2 equals to $24 per unit. Step 3. Apply the break-even quantity formula. Now we use the formula break-even quantity equals to fixed cost divided by selling price minus variable cost per unit. So we substitute the values 9,331,200 divided by 40 minus 24. That gives us 9,331,200 divided by 16 equals to 583,200 units. Final answer. The company must sell 583,200 units to reach the break-even point. That means at this level of sales, the contribution from each unit will exactly cover all the fixed expenses. There will be no profit and no loss. Also note, in break-even calculations, we ignore the effect of taxes, because there is no profit to be taxed when we are simply breaking even. Thank you for watching this episode. We will continue exploring cost-volume profit analysis in the next episode. Until then, make sure to practice the questions we discussed today and review your textbook to strengthen your understanding. See you in the next episode.